A
I think,
lot of bears going into that Nvidia earnings, man. A lot of bears got wrecked.
yeah, just from looking at Twitter and reading comments, I just saw so many people before the Nvidia earnings came out, just so many bears expecting Nvidia earnings to just crash. But like, this is a good prime example of don't fight the momentum. When stocks have momentum, you do not want to get in front of it. That's just how it works. Like a business that is performing successfully will continue to perform successfully until something happens that changes it. But I mean, Nvidia is just on a roll right now, and expecting something out of the blue to just all of a sudden, oh, they're not on a roll anymore, that's just the odds are against you. But there was so many bears out there expecting this to crash the market and did the exact opposite.
Nvidia hasn't seen a bearish trend since like early Q1 2023. So like ever since then, if you were bearish in Nvidia, you were just outright wrong and you've gotten wrecked
Yeah.
if you shorted.
Goes back
Like
to our
it's
saying from a few podcasts ago, your base case should always be bullish, and you
right.
should the bearish reasons need to prove themselves to you. And right now, I am really not seeing any, not just, I'm not just speaking for Nvidia, but in for equities as a whole, I am really not seeing any bearish signs right now. And that is totally stage 3. That is totally in line with what happens in stage 3. You get the euphoria. There's no reason for a recession. Nobody is expecting a recession. And that is one of the steps that need to happen for a recession to come. So we're definitely in that stage 3 territory, but stage 3 can last a lot longer than the bears can stay solvent.
Yes. And the same thing, like bullish trends tend to lead to higher prices, right? So when we say your base case should be bullish, unless you have a reason to think otherwise, a good example would be the growth slowdown that showed up in the models early 2022, or excuse me, late 2021, early 2022. That was an indication. There's one right there, right? And then Nvidia going bearish trend. If you were bearish in Nvidia, you had supporting facts to say, look, it's not looking, the outlook is not looking the best for Nvidia at the moment. Therefore, price could go lower. But as soon as Nvidia flipped bullish trend, now you have to start taking, you have to slowly start retracting that fuel that's giving you the reason on being bearish. If one of those two factors was the bearish trend in Nvidia and the negative growth factor, right? Nvidia going bullish trend automatically takes away some of that juice there for the bears. And it's sometimes it's really as simple as just saying, look, price is bullish on an individual name, right? Like Nvidia, price is bullish. So Nvidia can go higher and likely a lot higher than anyone possibly can imagine, given that everyone is upset in the fact that they've underperformed because they do not own Nvidia. Nvidia is one of those names where we saw it gap up 24% in May of 2023 on an earnings release. That was the ignition right there. After it rising up, a lot of people were upset after the earnings beat in the 14% earnings beat in February. And this kind of is like a snowball, right? Falling down a mountain and becoming an avalanche where every time this stock gapped up and they had the numbers to support it. You can argue all you want. Obviously, the company went from $100 a share a year and a half ago to $800 a share now. The company has made drastic improvements, right? In revenue. They're doing $60 billion a year now in as of fiscal year 2023 in revenue. So they're doing something right. And along the way, we saw a bear market in both growth expectations and equities in 2022. And coming out of that was pretty fierce. NVIDIA was on the forefront of that on the way up. And they continued to pretty much blast the street away at almost every one of these earnings calls or earnings releases. And then the after effects of that just compound on itself. And people are left just more and more I want to say euphoric in both directions, if that's a possibility, right? Like saying like the bulls are extremely euphoric, but the bears are just as euphoric in terms of hating on the stock, right? The hate just grows stronger. And it's one of those things where like bullish momentum is extremely hard to kill. And the more bears that get angry and upset at it, the more likely it's going to continue. And eventually it unwinds and implodes. But until we see a reason for that to happen, which for us, if we're going to start betting against Nvidia, it's only going to happen in a bearish trend. Now, we don't short stocks at Market Radar. We don't think it makes sense to go short companies that have the ability, especially tech companies like this. Like you could have shorted it in 2022, right? You were playing a very skewed game, because semis are one of those sectors where as soon as growth accelerates, they blow up, right? Like you can look back in 2021, we can go back in time all you want with Nvidia, right? When growth is strong, these semis do well. So it's one of those things where like as soon as growth starts shifting, boom, they blow up. And like if you're short that, you're just fighting an uphill battle the whole way down. And it's just not something that makes sense, right? So if you're shorting things, be very careful. We don't short at Market Radar, we tactically long, and therefore we're not so concerned about targeting these shorts. It's more of getting out of the way when things don't look as bright. But back to the S&P 500, the trend remains bullish. And if you want to take this from a structural standpoint, it's very simple. As long as we're above mid-vamp, all new all-time highs are to be automatically expected. You are to expect new all-time highs every single day. Wake up in the morning, look at your phone, and know that by around noon, there will be a new all-time high as long as we are above mid-vamp. It's very simple. Now, if we're below mid-vamp, things get more complicated. You have the potential and the almost opportunity to get to lower vamp and just do the sideways consolidation, right? But once you're above mid-vamp, expect new all-time highs. It's a pretty easy approach, especially when the underlying market we're in a bull market. You should expect those things.
Yeah,
now,
and you have the regime in your sails, which right now
right.
we do.
Right. So let's talk about bonds, because this is a little bit of throwing people in a little bit of a whirlwind here. People are kind of confused. They are. There seems to be this majority of the majority of the financial populace believes that the Fed needs to hike further from here because the equity markets are at all-time highs. Right. Just because equity markets are at all-time highs does not mean the Fed is not restrictive.
Yeah, we've actually seen the federal funds futures climb back and really price out those rate cuts that they had priced in just a month ago, even just half a month ago. They really came back, which adds restrictiveness.
Right. And it's funny, right? It's funny you say that. So the outlook of cuts got the projected number of cuts was reduced and the markets still go up. Right. So automatically the bears are going to say, oh, look, that already means the Fed's not restrictive enough. But we can go back in time when the Fed, just in the last 10 years, there's been multiple times where the Fed has cut rates and the stock market has gone higher. There's been multiple rate cuts in the past where the Fed has reduced interest rates and the stock market has gone higher.
Right. That's a really linear way of thinking of just, rate cuts happening. That means stocks have to go up, and rate hikes going up means stocks have to go down. That's a very linear way of thinking. It's not linear like that. It's a lot more complicated.
Right. And I guess to clarify what I said was I meant to say what you said there, going both ways, right? We saw the Fed come off the floor after in going into 2015, 2016, 2017, and then 2018, right, where they were lifting the Fed funds rate. And the market went higher. So they were able to hike with the market going up. They were able to bring rates down with the market still going up, right? So your question shouldn't really be, it should be the level of restrictiveness where the Fed goes beyond the bounds like they did in the end of 2018, where the market pulled back pretty harshly, right? It's where the Fed kind of blows their gasket, either going too restrictive or too easy, and that's where the problems occur. And I think you have to stay focused on what's going on here. Where the main objective is inflation, right? That's what the Fed is. They have maximum employment, so they're really only concerned about inflation at the moment. And this is where we open the door for a lot of nonsense, right? If we take a look at one of these photos here from that was posted on Friday morning, it's of the U.S. break-even 1-year index, right? And this is not an inflation swap. This is based off of TIPS, right? So Treasury Inflation Protection Securities. The problem is there's no such thing as a 1-year TIP. It doesn't exist. So how are you deriving this yield, right? And this is a Bloomberg index. And it's not, there's no such thing. So the way it's calculated, and it's not made very clear on the platform, but the way I'm going to based on my knowledge and understanding how this is calculated, they're using treasury inflation secure tips basically that are off the run, meaning like they have 1 year to maturity. They're building a composite index on that, and they're compiling this yield. So this is a very illiquid. This is not something that's traded actively. Whereas to an inflation swap, while you can argue there's more liquidity in the tips market than there is in the inflation swap market, the inflation swap market on a 1 year time frame is going to be more accurate than this. This is not a real break-even yield based off of auctions. That's not what is being calculated here. So when you look at this, you have to understand there's a discount component due to a lack of liquidity, meaning simplified, right? So you guys kind of get where I'm going. These things don't trade enough for this to be accurate. So when people are like, "Oh, 1 year break evens are at 3.6%," that means inflation expectations are drastically accelerating. Right? Let's first off, to analyze 1 year inflation expectations is probably one of the more macro pill things you can do. Complete nonsense, garbage. You do that, you're already setting the bar very low for your success. Okay. What we have is we track the global inflation swaps on a 5 year period so we can get a broader, more medium belly curve view of where inflation expectations are going, right? And as you can see here, inflation expectations in the United States and in the Eurozone remain very well anchored. We are well off the 2023 highs. We are well off the 2022 highs. Whereas if I looked at something like this, you'd think, oh my God, we're back to the 2022 highs. Nonsense.
Well, why is that? Is that purely just because it's illiquid?
I think so, yes. And now I haven't been able to find much transparency on the platform when I look into how this is calculated. I can dig into it a bit more, but based on the overview of what I've looked at, I can tell you that base cases, there's no 1 year tips. We know that they don't auction 1 year tips. So how they come up with this index? And this is not a 1 year inflation swap either. So based again, high level analysis, they're using off the run treasuries that are illiquid and not being traded. So they're already discounted. So there's already a discount there that when these assets are moved around, especially closer to expiration and cash is being moved back and forth, it offsets some of these yields. This is nonsense. If you were to pull up the 1 year inflation swap is nowhere near this value. Nowhere near. So for you to think that this is where inflation is going based on this, I would advise you do not look at 1 year. I would even advise you do not look at 1 year inflation swaps. Don't even bother with such a short time frame, right? Because you don't want people that are going to protect against it. The issue that you don't want to run into is people that are trying to time 1 year inflation time frames. You're trying to find the general consensus over the long term, right? And why do I say the long term? Why is 5 years more important than 1 year in terms of inflation swaps? And this is something you guys should remember when you're going through X and you're seeing all these posts. 1 year inflation, this 1 year break even, that. Inflation is mainly derived off of expectations, right? And the reason the Fed cares so much about inflation expectations and specifically longer term inflation expectations is because if you have a greater expectation of inflation rising over a longer term horizon, it's going to yield essentially higher inflation as people expect higher and higher inflation over the long run. So when we look at something like 5 years, we're not going out as far as 10 or 20 years. Because that's too far out. There's too much that can happen. 5 years is kind of like the midpoint where it's like, okay, we're not too far out on the curve, but we're not having a bunch of irrelevant noise on the front end of the curve. So we kind of get that belly there. And you can see that inflation swaps are well off their 2022 highs, then their 2023 highs. So Europe's even just above 2%. So there is obviously a lot of progress that's been made on inflation. And that is something that is constantly trying to be discounted on X by pretty much everyone. Now, is there a possibility that inflation could bounce a bit? Yes. I don't know how many times I have to say this, but I will say it again. It's very easy to get inflation from 9 to 5. Very hard to get it from 5 to 2. The road from 5 to 2 will be choppy. But there's a difference between choppy inflation and reaccelerating inflation, right? There's a difference between inflation going from 3.4 to 3.1 to 2.9 to 3.2 to 2.8, right? In that range, instead of going from 3.1 to 4 to 4.5 to 6, right? That's a very different path. You have to understand that when you look at the market as a whole and understand what the market already knows inflation is going to be somewhat sticky. It already understands that. Why do you think crude oil is not under $60 a barrel? Right?
Right.
There,
And
like,
and even having inflation at these levels, so slightly above 2%, hovering between 2% and 3%, as long as that stays consistent and predictable, that's going to be another bullish factor for equities, because equities are an inflation protection asset. All
to a degree,
assets,
yes,
all
yes.
assets to a degree are inflation protected. They're pricing in the higher rates of inflation. And so that's just another bullish case. That's not even a bearish case. It's when
Right.
inflation expectations become unpredictable, that's when you can get into the territory of being bearish on stocks, as we've seen in 2022 and 2021.
Right, exactly. And I mean, if we can look at something as simple as crude oil, right? In the last year, crude oil is up 3.48%, right? This is crude, just crude as, we'll look at commodities, even better. Commodities in the last year are up 3.22%. Okay. We're not even above the September highs in commodity prices. Commodities remain bearish trend. Everyone's so concerned about inflation accelerating. Well, at least give us a bullish, put commodities into a bullish trend. Then we can start even accepting the idea of higher inflation. I mean, crude oil, like, unless this thing's above 80, why are we talking about inflation accelerating? Yeah, it's like I just said, it's going to be bumpy, right? Inflation's not going to go from 3 down to 2 in a straight line. It's going to chop around. But to sit here and say, oh, look, it's going higher, inflation's going to accelerate, give us the proof. Don't just say, oh, look, how housing this, shelter that. You can argue all you want about your super core nonsense. It doesn't matter. At the end of the day, give us a fundamental reason of higher input costs and raw materials to even just start considering the idea that inflation could start reaccelerating. And we're not seeing that, right? So until we can even remotely put crude above 80, I don't see how we're going to start talking about inflation accelerating from here. And the fact that crude isn't, again, breaking new lows is another sign that of the thing that we've been mentioning pretty much consistently over the last year, the risk of inflation pinning sideways. Inflation remains a problem. And that was the main reason behind stage 3 of the compound landing. The Fed is not going to just cut rates instantly down to 2%. They're going to have to come down nice and slow, because the economy is attempting and is doing so right now of normalizing at a higher rate of interest, right? At a higher level of Fed policy. Fed's at 5.25%, and growth is still chugging along. But the problem is that the Fed overstays their welcome at 5.25%, and we take a look at their real policy. So this is the difference between a 1-year inflation swap and the Fed policy that's anticipated a year from now, and the anticipated inflation rate a year from now. So we're looking forward. Remember, the market likes to look forward. We're not looking at what the Fed's inflation Fed rate is today and what the last CPI rate. That's all noise. That's nonsense, right? So we can see that going forward, the Fed's at 2% level of restrictiveness. They're in a 2% real positive policy rate. The market's pricing in the Fed being 2% above the rate of inflation a year from now. How accurate that is, we'll see. But that's not the whole point. Is not how that is a year from now, if this being right. It's what the market assumes is today, right? The market's pricing this in today. So a year from now, this will be completely different. But the market's assuming this is what the outcome looks like a year from now today. So the market's thinking the Fed's going to be this restrictive a year from now. So when you say, okay, what happens if the Fed just holds here? Well, what's going to happen is inflation's going to continue to deteriorate. This number is going to just keep going up and up and up and up. And the Fed's going to become over restrictive without actually having to raise interest rates. And therefore, they're going to actually do more damage and increase the risks of sending us to stage 4. And that's the whole compound landing theory, right? We're in stage 3 right now. The Fed's at an adequate level of restrictiveness, regardless of what people want to say. Now, if they stay here too long, they actually become too restrictive, and they do too much damage, and they actually avoid the complete possibility of a soft landing. And we think that's really what's going to end up happening here. The economy is just going to chug along, and the Fed is going to end up sitting around and saying, you know what, we're going to just take it too slow, or we're going to try and take it slower than we think we should, because obviously we don't want to overstimulate the economy, and in turn their policy lags of them cutting rates will take too long to come into the market, and they will end up overshooting this restrictive period, and therefore sending us to stage 4. But within the grand scheme of the compound landing, going from stage 3 to stage 4, we have to understand stage 3 can last a lot longer than anyone thinks. This idea that, oh, stage 3 is it's only a quarter or two, so I might as well just sit here and wait for the bond trade. The bond trade's not here. It's not here yet. It might not be here for another 3 quarters. Who knows? 4 quarters, a year, 2 years. We don't know yet. The amount of policy lags that are in this cycle are immense. The fastest rate hiking cycle pretty much ever, right? And now we're dealing with the Fed facing the position where the economy is chugging along and they want to cut interest rates, but they're not sure yet. The market's jawboning between rate cuts and 6 rate cuts, 3 rate cuts. It's going back and forth. There's a lot of there's a wide range of dynamics here that are very, very new. There's not something that we've had a lot of experience with. So expect things just to be more abnormal. We can go and the market can run a lot longer than most people think. That's why the system is so valuable, and having something like the RQF that systematically just takes an approach of no feelings, no emotions, just looking at the situation and saying, this is what the situation is, let's take advantage of it. And it's going to attempt to. It's not always going to work. It's not always going to catch every move. But the idea of saying, look, the recession's coming, so we'll just sit here and watch, all that really does is put you in a position to buy higher. That's really it, right? You end up saying like, oh, at some point, even the bears are going to say, well, I guess the economy really is strong. Some of them never do, and they stay permanent for the rest of their lives. But you get my point. You just have to follow the flow of the data. Stop being so caught up in the narrative. The compound landing was built around the data. The data is not built around the compound landing. But
something important to note too is the S&P is only 10% above its highs before we hit that inflation recession, whatever happened in 2022. We are only 10% above those highs. I'm talking more so the SPY.
Right. Yeah, just about.
Yeah, 10%. And so even having the bearish case of, oh, the market's up too much, in the grand scheme of things, it really isn't. And I think stage 3 can really burn for a lot longer before we flip over to stage 4. I mean, growth has stayed strong, and really that's the only part of the equation that matters right now. Inflation has come under control. Now it's all about growth. Is growth going to die off because of the over-restrictiveness that we're seeing right now? And so far, we're not seeing growth die off. I mean, look at NVIDIA. Look at all the other tech companies. The growth is not dying off right now.
Right, but it's going to be skewed, right? And the reason why it's going to be skewed towards those bigger companies is they don't have this high debt burden, right? Like these small cap companies. So they don't have this refinancing risk. They don't have the same pressures from the capital markets due to their requirements to borrow, and especially at higher interest rates. That's why there's such a divergence between tech, and then even within tech, the mega cap companies that are just cash printing, money printing machines versus the companies in the Russell 2000, Russell 2 and 3000, right?
Yeah, the Russell definitely is being affected by these higher interest rates, and that's
why you can see. I mean, we're still well below.
It's been lagging so much behind, and I think even that just caught a lot of people off guard, because typically during bull markets you would expect the Russell to outperform, but this is a different case.
Right. So, but I want to, before we end this in this podcast, I want to go over Rivian. So I know we spoke about this probably 2 or 3 months ago. We spoke about our thesis on Rivian, and our thesis on Rivian has not changed. Now, I know this has been making news. It's been in the headlines, right? Rivian, they dropped Q4 numbers on, I believe it was Wednesday, and the stock was down 25% overnight and then 10% or 12% the next day. So Thursday and Friday down 25 and 12% respectively each day. Now, what's going on here? Well, the company is basically in a position where they are implementing some cost-effective adjustments to their production line. So they have to cut the guidance down in fiscal year 2024 to get that product line more efficient, the production line more efficient, right? They're looking to get to a positive gross margin in 2024 at the end of 2024. So going into 2025, they want to be in positive gross margin territory. Now, a little bit of summary here. What's going on? They produced 57,000 vehicles in 2023. Now, you might look at a company like Tesla and say, wow, Tesla produced 400,000 vehicles. Rivian that's like a pimple, right? It's nothing. But in terms of what Tesla actually produced that's competitive to Rivian, you have to understand that a lot of those vehicles that Tesla produced, of that 400,000, are Model 3s and Model Ys. In terms of their other models, which include the S and X, Tesla only produced 70,000 vehicles. So Rivian is giving in that higher space, in the premium EV space, right? Not the lower end mass market. Rivian's giving Tesla a run for their money. Now, Tesla bulls will probably shit on this, and because they get upset, some of them, not all of them, they get upset that there is an alternate option in the space. Now, okay, that's all. That sounds good. Rivian's doing well. Why is Rivian down almost 30%, over 30%, right? Why is Rivian down 53% year to date? Well, this has to do with the fact that two things happened. Number one, because they're implementing they're doing some changes to their product line. Like I said earlier, they're going to implement these cost-cutting structures. A lot of Rivian's contracts for their products were structured before Rivian had this these massive production numbers. So Rivian went to suppliers a couple of years ago. They were nobody, right? They haven't produced anything. So these contracts were not in Rivian's, and not really favorable towards Rivian, but they had to strike them to get the vehicle production going. Now Rivian's at a point where they can renegotiate these contracts, and they already stated that they have on most of them. The problem is this requires changing out some suppliers. Because of that, they are going to have to revamp the production line to basically make room for these supplier changes. And on top of that, they want to optimize their production line themselves. So that's going to require them to shut the factory down in Q2 to implement these changes. The CEO said that these changes that they're going to implement are similar to the changes they implemented last year in Q1, so Q1 of 2023, which boosted the margins on their electric delivery vans by 35. The cost efficiencies by 35%. I don't want to say the margins, right? So the CEO stated that this shutdown and these adjustments would be even more impactful than those made last year. So there's something to be a little bit more optimistic about than what you're basically reading in the news. Now, another thing brought this company down. Another thing that just absolutely smacked this company is Elon Musk came out on X and said Rivian has 6 quarters to go until bankruptcy. Okay, he basically showed a picture which was not so accurately representing what Rivian has in cash. It excluded their money market balances, which added an extra over about $1 billion in cash, right? So he calculated the run rate of burning $1 billion a quarter was a $7 billion cash balance, and saying they got 6 quarters left. The big news here is that Rivian next month in March is going to release the reservation ability for their R2 platform. The R2 is Rivian's Model 3 moment. So what does that mean for the company? Well, the company is in a position where they only have these high luxury ticket items on the market at the moment. They don't have that Model 3, Model X equivalent that Tesla does. So for the issue that they're going to have is getting that model to market. The benefit of this whole thing is Rivian's in a position where they can raise capital through convertible notes and equity offerings if they needed to. Now, equity offerings convertible notes are preferred against equity offerings and raising cash by issuing stock, but it's something that Tesla investors should be very, very used to. Like Tesla did a bunch of equity offerings, and we can take a little screenshot here. So Tesla dropped their Model 3 delivery. They opened up Model 3 reservations in 2016, right? And going into 2016, they did all types of equity and debt offerings. So Rivian has done about $3 billion so far in convertible notes in the last year, right? And they will likely do more. It's not, they're likely going to need to raise some money. I mean, they got $9 billion of cash on the balance sheet. What they're going to do here with the R2 reservations in the next month, they're going to get some influx of cash, but they're likely going to need to raise. And I think that Elon might have sparked a little bit too much fear in terms of bankruptcy. I don't think Rivian's going bankrupt. I wouldn't, if I did, I would have sold my shares. But we bought stock in Rivian. I have a cost basis of $15.90. And I'm going to hold Rivian because I don't think that the shocking news that so much is taken so negatively off the rip is that bad for Rivian? Because I expect there to be some headwinds here going into the R2 product launch, just like Tesla had when they were ramping up the Model 3. But in the process, I think that you're buying a company right now it's at a 10 billion. I think we paid roughly 12 to 15 billion in that range for the company, that if they are successful with the the R2 launch, I think this is easily $100 stock over time. So for us, this is our long-term portfolio. I want to clarify, this is not something we take massive stakes in. This is not the Bill Ackman approach where we'll put 30%, 40% of capital behind one name. For me, maybe 5%, something like that. And we let it ride. This is the equivalent. This is the most intellectual lotto option you could play, right? When I say, is Rivian the most intellectual option? That's not what I mean. In terms of picking up shares long-term with a thesis, if it doesn't work out and Rivian goes bankrupt, 5% NAV hit, RQF will easily cover that over the long run. No big deal. But if it does work and it goes to $10, it goes to $100 a share, you make close to 10x, right? Or 20x. So at that point, you take 5% times 20, you've made 100% of your account, right? So you have to adjust risk accordingly, manage your own risk. None of this is investment advice. Obviously, you have to do as you see fit for your own situation. For me, I like to stick around 5%. We play the long game. There's nothing that's changed in this earnings call or in the outlook in the company. I still like the stock, and I think it still has a very, very bright future despite a lot of the negative headlines. So I think that's where we'll wrap up the podcast this week. If you guys have any questions, feel free to reach out to us on Twitter or X at The Market Radar, and our website at market-radar.com, where you can find a free invite link to our Discord. Thank you guys, and have a great week.